right, you ready?
The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and thank you so much for taking the time to join us today to discuss the recent Ford buyout offer. My name is Nick Defenthaler, and I am a lead financial planner here at the center, and I'm also the director of our firm's financial planning department. And today we're going to take a look and do an overview of the key elements and the key points of the recent Ford buyout offer. As you may have heard in the news, roughly 15,000 salaried employees of Ford were recently offered a buyout, and every situation is a little bit unique. So we're going to go over some of the nuances of the rollover, the nuances of the buyout offer, talk about different pension options, whether it be the monthly payment option or the lump sum option if you so choose to retire at Ford and you do have access to a pension. Just kind of go over those basics and do a refresher, because there are some really key points that we want to center in on, especially in regards to tax implications, and then of course touch on different planning strategies as well that one might consider whether you choose to accept the buyout offer or not. At the end of the day, this decision really is focused on, do you want to continue working at Ford or do you not want to continue working at Ford? That's kind of where you need to start when evaluating this offer. And then once you kind of determine what that looks like for you in your own situation, you can drill down a little bit more on these details to see obviously which option makes the most sense for you. Before we dive in to the details here, I did want to make quick mention that we are recording today's presentation. There will be access to the recording in a couple days on our website, but we have disabled chat functions and aren't going to be taking any questions today, because I do certainly want to be respectful of everyone's time and wrap up promptly at 12:30. I'm sure people are listening in on lunch breaks and that sort of thing, so certainly want to be respectful of time. So if you do have questions, my contact information will appear at the end of the presentation, and by all means, feel free to reach out to me directly or anyone here at our team at the center for follow-up. So before, I guess, we do dive in even more into the details and talk a little bit more about what the offer actually means and some of those details, I thought it would be interesting just to take a walk back in time 30 years ago. Donald Trump was actually on the cover of Newsweek. He was 41 years old at the time, and I'd venture to say not too many people at that time thought that he would be running our country like he is right now. So regardless of your political views, I just thought I got a chuckle out of this looking back 3 decades ago of the evolution, and just a perfect example of things that we don't expect could happen oftentimes do. Gas was 79 cents a gallon for regular unleaded, and that god-awful body style of the 1987 Ford Mustang was still in existence. Black Monday occurred in the stock market. The Dow Jones fell 508 points, and that was the equivalent to roughly 22.6%. To put that in perspective, because obviously the market is a heck of a lot higher now than it was back in October of 1987, if we saw a 508-point drop today, where the market's at currently in the Dow, that would translate into a 2.4% move. So that just shows you how much things can change in the world that we live in today, in our own situations. I'm sure if you look back and you say, geez, what was I doing 30 years ago? So many things have happened throughout your lifetime that you just simply didn't expect was going to occur. We can't map out every single detail of our lives. So the reason why I bring this up is because realistically, the decision that you do make with this buyout offer could potentially affect the next 30 years or so of a retirement. So it's absolutely critical that you do take your time and you consult with a professional, whether it's someone on our team or someone that you work with independently on your own. Definitely want to spend some time and make sure that you're making an informed decision that's certainly unique and tailored to your own situation. So let's kind of get into some of the details with the actual buyout offer, okay? So there are actually 2 components to the buyout offer. Some people receive both. I've heard that some receive one or the other. So let's focus in on the first option, or first route that you could potentially go when either accepting or declining the offer. So the excuse me, so the first one would be the Special Incentive Program, or the SIP. So I'm going to use the acronym SIP a few times. So that's going to refer to the Special Incentive Program. To make it as simple as possible, this basically gives you a severance if you decide to leave Ford and take them up on the offer to receive the buyout. Depending on how long you have been with Ford and been with the company, that's going to ultimately determine how many months of severance that you ultimately receive. So the most that one could receive by working at Ford for 20 plus years, for example, would be 18 years. And we have a few clients who have been offered, have seen this package come through their email with Ford. And the majority of buyout packages that we have seen, clients have worked there for more than 20 years. So I venture to say the majority of folks who receive this offer are probably in that 17 to 19 year time frame, or 20 plus years. So what does that translate into? Is there a planning opportunity with that? That could mean up to 27 months of income in 2017. So how am I getting to that number? So if we say, okay, well, the latest that you can work, and we'll get into some of the other details in a few minutes, but I'm going to kind of fast forward a little bit. If you decide to take Ford up on the offer, you have to retire by the end of September this year. Okay, so that's 9 months of income. Plus, if you're in that 20-year of service range, that's 18 months of income on top of those 9 months of income that you receive by working January through September. So more than likely, that is going to push you into a higher marginal tax bracket. You're going to be paying higher tax, more than likely, than you would have if you would have never received that severance and you just simply worked throughout the duration of the year. One important component as well, obviously you're subject to federal, state, and payroll tax. So payroll tax is Social Security and Medicare, the portion that you pay as an employee that ultimately goes to help fund your Social Security and your Medicare benefits in the future. So realistically, if you're in the 28% tax bracket, which more than likely many folks will be in that range or potentially higher, when you factor in a 28% federal tax bracket, 4.25 for state, and then another 6.2%, you're getting really close to that 40% mark pretty darn quick. So we're going to talk about some different planning opportunities that you might explore to lower that taxable income as much as possible. It is what it is in a situation like this. You're receiving a bunch of income in one particular year, so you're going to get peppered on taxes. The only thing that we can do is take advantage of some of the other planning ideas that I'll touch on in a few minutes that, like I said, can ultimately help lower your taxable income and many times even lead to further funding your overall retirement. Okay, so the next or the other component of the buyout offer is the Select Retirement Program, the SRP. Okay, so this is really in relation to your overall pension benefit. Okay, so I have on the screen 3 plus 3 equals 15. What the heck does that mean, right? So basically Ford is saying, if you take this buyout offer and you don't elect to do the SIP or that severance package, we're gonna boost either your lump sum payment when you retire or that monthly payment option that you have for your pension. So they're going to give you a credit for an additional 3 years of age and 3 years of service. So that can ultimately lead to roughly a 15% increase over your normal GRP, which stands for the General Retirement Plan, the BEP, which is the Benefit Equalization Plan, or the SERP, which is the Supplemental Executive Retirement Plan. Ford loves to have, and I've seen it with all the auto companies, they love to have all these different acronyms and all these different plans for different levels of employees and things of that nature. But the bottom line is you can expect approximately a 15% increase in your overall pension, whether it's the monthly payment or the lump sum, if you elect to receive this portion of the offer. So we touched on taxes in the previous slide with the SIP, with the severance package. Tax implications with this option, with the Select Retirement Program, are going to be a little bit different. So because they're not being paid out in any one given year and it's not considered earned income like a severance, you're not subject to that payroll tax. Okay, so anything that, any tax that's associated with the pension is not going to be realized until that pension begins, or if you elect for the lump sum and you roll the funds over to an IRA, ultimately when you start taking money out of that IRA. So many clients, depending on your situation, of course, will elect to do the lump sum payment to an IRA. Maybe clients have significant Social Security benefits, and they really don't need an additional fixed income source in retirement based on what they want to spend in retirement. Well, then the IRA lump sum payment for the pension could make a lot of sense, because you can ultimately, in most cases, pass anything that's remaining in those IRAs to future generations, things of that nature. There's a multitude of reasons why you might want to do one or the other. But the bottom line is that you are not going to pay any tax immediately when this occurs, if you facilitate the rollover properly, and as long as you're not immediately turning on that pension benefit. That's the main takeaway that I want everyone on the call to get. So some other key components of the offer, and this is regardless if you elect the SIP or the SRP. So the decision deadline is July 24th. So you have a couple weeks, so the clock's kind of ticking here. Many clients have already made a decision, or they've evaluated their options, have spoken with us or their financial planner to see which option makes the most sense. But if you haven't taken a look at this, we definitely recommend you kind of get on it and you take a peek and you reach out to someone that you know and that you trust that can provide some financial guidance to give you a second opinion, or to make sure that you're evaluating everything the way that you should. Employment assistance. So Ford is actually going to offer you up to 6 months of employment assistance. It probably goes without being said, but you cannot work for Ford or certain subsidiaries of Ford, things of that nature. Healthcare. If your hire date was before June 1st, 2001, you're more than likely going to be eligible for continued healthcare in retirement until you're eligible for Medicare, which typically kicks in at age 65. If your hire date was on or after June 1st, 2001, you're eligible for a health reimbursement arrangement account if at the time of termination you had 10 years or more of continuous employment with Ford after attaining age 45. So to recap on that, different rules or levels of coverage could apply depending on whether or not your hire date was before, on, or after June 1st, 2001. Vacation. So what happens to all your vacation if you decide to take Ford up on this offer and you retire by September? Anything you've accrued through your last day on payroll, unused accrued vacation is paid out if the last day on payroll is prior to year end. So essentially, if you've accrued vacation time, you're going to get paid for it. If you purchased vacation time, those, however, will be forfeited upon termination. Life insurance. You are eligible to maintain if you were hired on or after January 1st, 2004, are age 55 or older with at least 10 years of service, or are age 65 with at least 5 years of service upon termination. So lots of nuances there. So just to recap, the magic date there is January 1st, 2004, and it does depend, obviously, how old you were when you started with Ford as well, and how much continued service you had. The 401k, or the SSIP, another acronym that Ford likes to use, that essentially is referring to the 401k plan. Any matching contributions or funds that you're contributing into the plan will stop upon termination. So if you end up retiring at the very last point and you leave Ford, you accept the buyout, and your last day is September 30th, then that's when your matching contributions and your ability to contribute to the plan will end. If you do end up leaving Ford, you have the option of either keeping the funds within the 401k or rolling them out to an IRA that either you or your financial planner can help manage. And as I mentioned several times, the latest that you can stay at Ford and take them up on the buyout offer is September 30th. So pension funding. Let's talk about pension plans a little bit for a few minutes. This is an area where if you are a new employee entering the workforce, the likelihood of you receiving a pension where a company is essentially saying, we're going to pay you a defined benefit, whether it's a lump sum or it's a monthly payment upon your retirement, is probably as likely as winning the lottery and getting struck by lightning in the same day. All joking aside, it's very rare to see this, to have access to a pension plan anymore. And realistically, the main reason for that is too much uncertainty with funding. It costs companies an exorbitant amount of money to maintain pension plans, and that's simply why the majority of companies, both large and small, have shifted to defined contribution plans, which are your 401k or 403b, things of that nature. So the Ford plan is currently fully funded. So we use this bathtub example because if you kind of want to think about pension benefits, if you have that faucet to the bathtub and that stopper closed, the water's still rising, the faucet is filling up with water, there's water coming out of the tub. You're able to collect benefits and you're able to continually build upon that benefit that you already have. Now, many companies and several in the automotive industry have frozen their pension benefits. So using that same bathtub example, the faucet has been turned off, but there's still water in that bathtub that's getting used to help fund retiree pension plans. So I'm sure everyone on the call is familiar with, back in 2012, GM and Ford both did some pension de-risking. And basically what that means is, several of the companies, Ford and GM, as I mentioned, they extended offers to retirees to say, you know what, where you can either keep your benefit here at Ford and do the pension. GM offloaded that liability to Prudential to pay benefits because, like I said, just simply too much liability and uncertainty around pension liabilities long-term for retirees. Or you could do the lump sum option. So I personally would not be shocked if we saw another wave of this in the next 5 or 6 years or so. The way that the country is leading to with defined contribution plans, and like I said, just so much uncertainty, and pension being such a big liability on a company's books, companies just simply don't want either the cost or the potential liability of having to fund a retirement for someone for the next 30 years or so. So let's talk about rollover nuances. Okay, so let's say you elect to go with the SRP and you say, I was going to leave Ford anyways in the next year. It's going to make sense for me to move on and take them up on this offer. I want my pension benefit to increase 15% roughly, and I'm not going to do the severance. I don't need all that additional income in 1 year. I'm more focused on increasing my long-term monthly pension benefit or the lump sum that I do. Okay, so you end up meeting with your financial planner, and he or she recommends that you end up doing the lump sum to the IRA. Using a previous example, let's say you and your spouse have healthy Social Security benefits, you have significant outside assets other than your 401k at Ford, and realistically, you have the ability to do the lump sum, take the investment risk within the IRA, because you really don't need to have another fixed income source in retirement. So let's pretend that you end up going through with the lump sum. And then you also, upon retirement, decide that based on conversations with your family and your investment professional, that you would like proactive investment advice and that you want your financial professional to help manage your 401k and roll that out to an IRA. So that way it can be more proactively managed and someone can be looking at it constantly and have better access to different mutual funds and things of that nature. Okay, so if you decide to do what's known as a rollover, it's very, very important to note and to fill the paperwork out correctly where you don't end up doing an indirect rollover. Typically not something that we recommend. Okay, so an indirect rollover a check is made payable directly to you. Okay, so it's made payable to Mr. or Mrs. Smith, goes directly to you, it goes in a checking or savings account, and 20% for taxes are withheld out of that check. And then it's on you to make sure that that money gets into a traditional IRA within 60 days, or that entire distribution ends up being taxable, which obviously could be hundreds of thousands, if not millions of dollars that you might have in your 401k and the pension lump sum, if that is something that you decide to elect. So if that were to happen and you were faced with a $500,000 tax liability simply because you didn't process the rollover properly, you're probably going to have a face like this, which is my son actually in the bathtub, where on New Year's, when we tried to put a New Year's hat on him and he wasn't too thrilled, obviously. This is probably going to be similar to the face that you're making when you realize that simply not filling out paperwork or not getting a check deposited into an IRA is costing you big bucks in taxes that you probably could have avoided. So in most cases, almost all of them, we're going to recommend a direct rollover. So a direct rollover, a check is made payable directly to your IRA. It will say made payable to John Smith for benefit of his traditional IRA. So that way it's made directly to that IRA. And so when that happens, you don't have to withhold any taxes. The check goes directly to the IRA. You don't have to create this additional step. It's just a much cleaner process, and it dramatically reduces the amount of errors that you're going to have. So if you're anything like me, I like to simplify my life. So this is a picture of my son in his normal happy-go-lucky mood that he's in. And this is probably the face you're going to be making when you realize that all you need to do is just send the check either to the Center for Financial Planning with Raymond James and get the check deposited into your IRA or whatever firm that you work with, obviously. But at the end of the day, it's just a much cleaner and an easier process that dramatically reduces the propensity of errors. So let's talk about a few planning considerations. So some things that you would definitely want to consider before retirement, regardless if you select the SIP or the SRP, would be absolutely maximizing your 401k. This is going to be the last year, potentially, that you're working. Of course, there's employment assistance for up to 6 months, and you might want to continue working, but many folks at Ford who take this offer are going to be done, okay? So this is your last opportunity to contribute to the plan and make sure you get as much money into that particular account as you possibly can. If you select the SIP, for example, so you're getting that severance, you're at Ford for 20 plus years, and you have a total of 27 months of income in 2017. If you contribute and you maximize that 401k plan, every dollar that you put in is going to lower the amount of income that you're being taxed on if you're contributing to the pre-tax or traditional 401k option. So if your spouse is working, for example, if you both have access to a 401k plan, let's say the wife is working at Ford and she takes Ford up on the buyout offer, and husband typically doesn't maximize his 401k at work. Well, it could make a lot of sense, especially like I said, if you elect the SIP and you have all this additional income coming into the household, you're going to have enough cash flow, more than likely, to be able to fund another 401k plan, which not only is going to lower your tax liability even further, it's going to help fund your retirement plan in the future. Health savings account, or HSA maximization, it's the same concept in regards to taxes. HSAs are just a phenomenal tool to consider utilizing for healthcare expenses. Any money that you put into this account, you're not going to pay tax on. You're going to get a tax deduction. And if you use it for a qualified medical expense, you don't pay any taxes on that money, even if the money has been growing and you've invested it and there's earnings. So tremendous account to consider utilizing for healthcare and retirement purposes. So if you decide to retire and you end up leaving Ford and you're looking to roll over your 401k and you have the Ford stock fund within your account, many clients purchase Ford stock when it may have been down to $2 or $3 a share back in 2008, 2009. and now it's up to, maybe $12 or $13 a share, depending on the day. Depending on your situation, it could make sense to explore what's known as net unrealized appreciation with that forged stock. I'm not going to go into too much detail on that because I know we're running up on our time limit here, but it could make a lot of sense to end up rolling that forged stock out of the plan separately and paying tax on it a different way and realizing that tax liability immediately, so that way you can pay some preferential tax treatment and more than likely save taxes in the long term. So if you have any questions about that and you want to dig deeper, reach out to me offline. I don't want to spend too much time on this particular topic today. If you have an outside investment account, after-tax investment account, you could consider selling certain mutual funds or stocks that haven't performed all that well and do what's known as harvest losses. So you can intentionally sell a particular fund that hasn't done so well, realize the loss. You can write up to $3,000 against ordinary income each and every year, and even repurchase that same security if you end up, if you do want to hold it long term, you just want to make sure that you hold it long enough so you don't end up doing what's known as a wash sale. Charitable giving. Great time to ramp up your charitable gifts if your income is much higher in the given year. So if you elect to do the SIP, you want the severance, you have that 27 months of income in the given year. If you normally contribute $5,000 to charity, you might consider doing $15,000 and then not, obviously depositing anything or gifting to charity for a couple years or so, because you've kind of front-loaded those contributions in the year that you had really high income. What that allows you to do is receive a tax deduction when you're more than likely in one of the highest income bracket years of your entire life. So I always say, obviously we don't contribute to charity solely based on the tax benefits, but if we do charitable gifting strategically and tax efficiently, it realistically just leaves you more money to give to the causes that you really care about instead of giving those dollars to Uncle Sam. So a donor advised fund is something that we help a lot of clients out with. You're actually able to contribute directly to that particular fund, the donor advised fund, and you're not required to actually distribute the funds to the charity in that one given year. Many clients will actually contribute appreciated stock or mutual funds directly to the donor advised fund that have appreciated in value. And if we do that, you don't have to pay any tax on any of that unrealized gain that there might be with that particular position. So some really creative and great planning that can be done around charitable giving as well, if the buyout offer is something that you're considering. And finally, save or pay it off, or pay off debt rather. In many cases, that's the million-dollar question for clients, and it's something we help folks do all the time. Usually it's a balancing act, doing a little bit of both. So you have those 27 months of income in every one in 2017 because you elect the SIP. That's a huge influx of cash that you more than likely weren't going to see otherwise. So could make sense to evaluate, do you have any credit cards? Are you paying really high rate on your mortgage? Or are you a little bit behind on your retirement savings? Should you start building up an investment account, an after-tax investment account with those dollars? There's many different options that you have, and you certainly want to explore the ones that obviously make the most sense for your own situation. So as we wrap up here, final slide I have on here, don't try this at home. And then a lovely picture of, luckily this is not my home, I promise, where the TV is hung on the wall, looks like, and it took a spill maybe because the person doing it didn't have the proper training or maybe overlooked something because they don't do that every day. I'm not the most handy person in the world. My wife and I just recently got done finishing our basement, and I probably could have done some of the things on my own, but I said, you know what, I'm going to hire a professional. I want it done right. I want to delegate it, and I don't want to screw it up. So I bring this up because realistically, if you're considering the offer and you are considering leaving forward, it's a monumental decision financially that could affect you, like I said, for the next 3 decades. As we saw, looking back to 1987, look how much has changed over that time frame. None of us have a crystal ball. None of us know how life is going to play out. So I would certainly recommend, whether it's us or the financial professional that you currently work with, meet with him or her and make sure that you've covered all the bases and really fully understand the offer that's unique to you, and sit down and look it over and make sure that you're making an informed decision that you're going to be happy living with for the next 3 decades. So some items that we help clients with on a daily basis here at the center: educating you on buyout offers, 401k and pension plans. We could do an analysis of retirement preparedness. So, if you say, I'm really considering taking this buyout offer, but I want to spend X amount of money in retirement. If I take this offer, will it work? That's something that we help clients with all the time, helping out with, evaluating Social Security, determining which filing strategy makes the most sense, and really helping to tie everything in: Social Security, pension, your portfolio, what you want to spend, all those things to help create a tax-efficient retirement paycheck for you. And most importantly, I think it's worth mentioning, and I kind of mentioned in my own example of the home improvement that I had recently, is simply wanting to delegate the financial matters in your life. In many cases, the clients that we work with have been very, very successful. They've been good savers. They've invested well over the time frame, but they've reached a point in their life where they really don't want to have to worry about this stuff anymore. So they come to us and they say, we can trust you guys. You're going to do good work for us, and we just don't want to have to worry about it anymore. And so those are folks that typically we work best with, who delegate, and especially on their investment portfolio. And let's understand your financial goals, what's important to you, and let's help you get there. So thank you very much for your time today and for joining us on the call. Looks like we're at 12:30, pretty much right on the button, so I'm glad I was able to stay true to the half-hour time frame. If you have any questions, by all means, feel free to reach out to me directly. My email is listed on the screen, nick.defenthaler@centerfinplan.com. Our phone number is 248-948-7900. We've actually written a blog on the recent Ford buyout as well. You could take a look at that. Pretty much everything in that blog was covered today, but if you're looking for a quick refresher, or you want to use something for quick reference, the blog is on the website as well. Typically we do one webinar every month or every other month, so keep your eye out on our website and our emails for upcoming educational webinars and things of that nature, because there's usually always good stuff out there that you can learn a few things. So thank you once again for your time today, and I hope everyone has a great rest of the week.